Traders, Cousin Vinny coming to you from theclosingprint.com, January 25th, 2020. In this edition of your weekend video newsletter, we'll discuss our changing bias in the markets. We did accelerate some of our selling into strength on Friday morning, having taken many positions off this week with the indices lower, all except for the London Stock Exchange and FTSE, which moved higher last week. The international markets, Nikkei, Hang Seng, Bombay, were all lower, as was the emerging markets. FANG stocks were mixed. We did see Netflix obviously much higher last week. Nvidia managed a green close, and Intel was higher on earnings, in addition to Tesla managing to hold the highs. Bond stock ratio is starting to signal a potential change of direction in the markets. Junk bonds and high yield corporate, which typically lead the markets, are pointing to potential lower levels in the short term. When I say lower levels, I'm only looking for maybe 2 to 3%. We are slightly lower than 1.5% as of Friday's close on the S&P. The Dow Composite is range bound. It's moving sideways in a flag formation. And the S&P 1500 is still bullish to slightly neutral. XII is still in an uptrend, but it has pulled back to its 21-day moving average inside of standard deviation 1, which you know, if you've followed me for any length of time, is a caution signal. If we see a red stick, we'll get to that in a minute, that would be a sell signal. NYMO and NAMO started a bearish cycle a couple of weeks ago. They are moving lower as breadth deteriorates. Breadth thrusts are also bearish, and we did see the NYHL bullish and conflicting as a signal. So we do have some mixed signals this week. New York Stock Exchange advanced decline is in the red zone. You know, 2 days in the red zone is a sell signal. We'll look for Monday to bounce out of that area. And the S&P equal weight index is overbought, but above the 21-day moving average. Put call ratio, we did see a bullish spike to 1.10. If we get up anywhere near 1.4, 1.5, that would be a short-term fade the fear or go long the markets signal, so be aware of that. We had VIX spike up to 16 and then faded. Bullish percent is at 68 and dropping. And skew is also dropping from that high of 144.56 3 weeks ago to 127. It's fading. U.S. dollar is at the top of the descending wedge. If that continues higher, that should put pressure on commodities. We already saw copper in a waterfall move last week, in addition to what we saw in West Texas crude. Gold is holding up, most likely due to fear or safety as a hedge. We saw the heat map move back to neutral after being more bullish last week. Strength in internet, real estate, construction, and technology, with weakness persisting in energy materials and biotechs last week. Heat map for the international markets has been fading. Europe and China were weak. USMCA has had an impact on Canada and Mexico. They're neutral to slightly bearish. We'll look at some IBD 50 names that are managing to hold up fairly well. That could be in setups starting Monday or Tuesday. They might pull back a little bit more. And we'll look at some MarketSmith Growth 250 names showing relative strength in white, and the top 20 volume percent gainers last week. Bulkowski's still have 5 of 5 green with a CPI signal half red since January the 24th. Friday at 16.7%. That's bearish with 30 bearish patterns, 6 bullish patterns, and 181 patterns waiting for breakout. It's these last two numbers that have dropped markedly, telling us that we're seeing fewer bullish setups. Bottom line, the markets were overextended last Sunday when we presented the weekend video. We told you that we would focus on fewer positions. That's still the case, as we have moved many of the positions to the sold category. Just go to theclosingprint.com and look at the positions tab for those closed positions. The ARCA Institutional Index XII of 75 stocks most commonly held in institutions' core portfolios did fade back into standard deviation 1, the darker bands here. It did bounce, find buyers near the 21-day moving average, closed a bit higher at 1546. No red signals yet, and something that we need to keep in mind, there is a possibility we could bounce on Monday. Again, we need to keep in mind that we do have some mixed signals. The S&P 1500, 500 big caps, 400 mid caps, 600 small caps is still on a bullish signal, has yet to turn red like we saw back here in late July and again just before the October reversal. And histogram is still green, but fading, something we need to pay attention to. We still have no red sticks on the S&P 1500 as we found buyers near the 21-day moving average. And we note that Bollinger Bands are starting to turn inward, which could lead to a sideways pattern. While the three groups, the S&P 500, mid caps in the middle, small caps on the bottom, continue to show a potential fade setting up, still not producing lower lows and lower highs like we saw in late December 2018. So breadth is still okay, but fading. Do note this chart of the spiders that I attached to a blog post on Saturday, which would be a good idea to read. It covers some of our thoughts that we're going to cover in this weekend video newsletter. But as you can see, we've already started to lay out a plan in case the markets do pull back. Do note we're above the 21-day moving average, so until we lose the 21-day, we can only assume that we're going to bounce. We already saw buyers on Friday. That said, we did have a distribution day last week on Friday, and the cycle is starting to turn lower. This isn't an end-all in itself. It's just a plan for next week. We have three things converging: a channel down, the 236 Fibonacci level, and the 50-period moving average, which is rising up to meet price. So there's a very good possibility we hold the 21-day. Just watch for that on Monday and Tuesday. Also note, with the markets down right around 1.5% for the week, that the spiders have yet to produce a red stick. This is a Renko chart. It eliminates time as a factor, only looks at price. We'd need a pretty significant move to the downside in order for Renko to produce red sticks. We're still in an uptrend, and something that we should acknowledge going into this week. That said, Spider Weekly did produce an inside week. There is a possibility we could push a bit lower. Also, an equal possibility that we can continue to move higher because it's a lot of stocks that are still looking very strong, especially in the technology sector, which occupies a very large percentage of the NASDAQ 100 index. We did have a spinning top doji, RSI muscle, and MACD is still above its signal line and rising. So there's also a possibility that we could continue higher or lag for another week before transitioning to the upside. So just be aware that if technology starts to be weak, that would be something we need to pay attention to very closely. So the FANG stocks in particular would need to start to break down for us to get bearish. IWM was the worst performer last week. Pretty big red candle. We've been in a bullish trend over the last 15 or 16 weeks. Higher highs and higher lows. Just because we have a red candle doesn't mean that we're automatically going to roll over and move to the downside. We've had plenty of occasions over here back in 2017 and 18 where we rose and we created similar situations, pullbacks, that resolved to the upside. Again, this candle right here in particular, where we broke out of this flag, rose for 3 weeks, and then had this red candle reverse the next week and then followed through. So just because we have this red candle doesn't mean that the IWM can't continue higher. It is something we're watching, however, and key to the market strength at the present time as small caps continue to be in favor. though less in favor on Friday. That said, we did have a mixed signal last week with the New York Stock Exchange. There's over 3,100 stocks that trade on the exchange, and we did see more new highs than new lows. With this simple calculation with NYHL, new highs minus new lows, we saw an increase of 146 stocks, a 92% increase over Thursday. Closing higher on Friday, the moving average is still climbing. So this is a mixed signal and a caveat for the bears. While the New York Stock Exchange advanced decline makes the bears smile, we closed in the red zone on Friday. A second day inside of the red zone, namely Monday, would probably lead to a descending pattern, and reason to be careful and cautionary. I would still suggest taking profits into strength where you have them. Get closer to market neutral if you can, so that if we do move higher, we can start to focus on fewer names, as we pointed out last week in last Sunday's weekend video newsletter. Another caveat for the bears is that we could continue higher. This is the Dow Jones Composite, 65 stocks in the industrials, utilities, and transports group. Friday evening, Boeing got some okay news from the FAA. Boeing did rally substantially higher, showing a potential to follow through. While the airlines took that note and moved higher, we also saw a move in the rails as those moved higher last week as well, tapering off a little bit on Friday. So this chart is neutral, not yet giving us any reason to think that we're pulling back just yet. We had buyers on Thursday and Friday, as you'll notice with the wicks underneath these candles. Above the 21-day, we're still bullish Dow Jones Composite. As I pointed out on the S&P 1500 breadth, the large caps, mid caps, small caps, all pointing lower. The possibility that these breadth thrust indicators will pull back a bit more. So the good thing is that if we do get a bounce, we're not overbought above the plus 30% line. So there is energy to push the markets back up to the upside. And the NASDAQ, of course, is back to zero in the lower panel. Of course, we have to temper that with the idea that the NAMO, the McClellan oscillator for the NASDAQ, has rolled over. We pointed out this plateau a couple of weeks ago. We do see a move to the downside. If we got to a minus 70, minus 80 reading, that would be a reason to think we might see a short-term bounce. So there is a possibility that breadth could further deteriorate, as we can see here on the New York Stock Exchange, NYMO. That cycle is moving lower as well. We did get a red stick on the NYSE, so that's a caution signal. Another stick would be a sell signal. I would just take positions off if you have profits, as we've previously mentioned, and go to market neutral. Our VIX 60-minute indicator is also red and bearish on the 60-minute time frame, while the VIX daily chart shows us that spike we saw last week on Friday. We closed right in the middle of that long-legged doji. There is a possibility we could head higher before resuming the bullish trend in the markets, so be aware of it. And we also see skew making lower lows and lower highs. This is a measure of out-of-the-money puts being bought, an indication above 135 that institutions are actively hedging like they were back here in late August into the December drop. They kept buying and then unwinding those positions as the markets dropped. We don't see that condition now, indicating hedging as the spiders continue to hold the 21-day and are rising. Again, above the 21-day we have to stay bullish. Below the 21-day we can get more bearish. For now we just have hedges going into Monday morning. And finally we have the put-call ratio, which was full-on bearish. As this was in the red zone, it was telling us to look for peaks and then valleys once we get a spike in the opposite direction. If we get a reading of 120 or above on Monday, Tuesday, look for a short-term top, not the day of, but soon thereafter, because spikes into these zones, like we see here, led to this reversal back in October that gave us a 17-week run in the opposite direction. We were making profits all along this way, and the reason why we took a lot of positions off last week into strength and the week before was that we didn't want to give up a lot of those gains if we do see any further downside in the short term. Here's the S&P 500 weekly chart. In the upper panel, notice there is no red sticks. However, in the lower panel, we do have the UST 10-year bond to the S&P 500 ratio, the bond stock ratio. As this is falling, it's bullish equities. Every once in a while, we do get reversals short term. So over the next couple of days, if this doesn't change, we could see a reversion back to mean. Notice the 65 period moving average is rolling over like it was back in 2016 into early 2017. So while this is short-term bearish, it's long-term bullish for the markets as long as this continues to roll over like it did here in late 2016. While the longer-term bond stock ratio is still bullish, short-term, again, we are slightly bearish. We can see junk bonds, which tend to lead the markets in both directions as a risk-on, risk-off indicator, has crossed through the 21-day moving average like it did back in late July and late September. Those led to 1.3, 1.4% from the moving average to the low in each case. Presently, we show a minus 1.2, 1.3 potential pullback before RSI gets oversold again. We crossed through 50. That relates to the S&P 500 where we saw a 4.3% pullback. Again, as measured from the vertical line, which passes through where price dropped below the 21-day moving average in each case. So we took these two levels, approximately 4.3% from that signal, and projected it over here to the present time. So you can see if we pulled back another 4.3% or so, we would lose that level right here that we pointed out in the Saturday blog post, where we showed you a potential zone where price action could stop right at the 236 and this congestion right here where we broke out into January. So be aware of that zone as well, that if we did hit this pullback of 1.2%, that this would push us past this consolidation zone. All of those are probabilities. We have to see it first on Monday and Tuesday to get a better idea how to plan for the entire week as the week unfolds. As bonds move higher, yields move lower. In this case, we have the 10-year yield, which is back to 168. It was trading very near 2 a few weeks ago. This has pulled back, most likely as this breakout on the S&P 500 in the lower panel accelerated. We were looking for a little pullback, so that's actually a bullish condition longer term for your retirement accounts. We'd like to see a little consolidation at the present time, considering all the charts we've already presented thus far, in addition to the fact that as yields drop, bond prices rise. This is AGG, the Barclays Aggregate Bond Fund. This is what bond traders use as their benchmark, just as equity traders use the S&P 500 and the Dow Jones for their benchmarks. You can see that this is breaking out. We do have a position in AGG. Our retirement account is basically 45% bonds, etc., and about 45% in equities, both international and domestic, and another 10% in mixed assets like real estate. So if the markets do move lower, AGG and bonds will move higher. It'll offset. I'm basically market neutral at the present time. And of course, that goes hand in hand with TLT, the 20-year bond, which up until last week was still in this descending channel pattern we have laid out over the last 20 weeks. Now, this did break above that upper trend line, so that's a change in character that has to be considered if you're going to trade the markets for any length of time. So your retirement account is neutral, basically. We're looking for bond traders to increase their interest if we do continue this trend higher. This was the first leg. from October 2018 into this year. We faded. Is there another leg higher? We don't know. We'll have to see it first. But for now, bonds, AGG, TLT, IEF, the 7-10-year Treasury bond ETFs are all looking more bullish. MACD's turning. There's a possibility we could start another leg higher off of this consolidation that we've seen over the last 6 months. We've also seen an interest in the US dollar as a safety trade. Moving back to the top of this wedge pattern, over the last week or two, we thought we might stay below the 200-day, the magenta colored line, and the 50-day, the green colored line. Instead, we passed through this level, we bounced off the 10-period moving average and started rising. We did see a little selling at the top Bollinger Band on Friday, but RSI rising and MACD above its signal line and moving higher suggests that we could see more upside in the US dollar as traders look for safety in the US dollar, which would impact commodities, of course. As the dollar rises, it takes fewer dollars to buy the same commodity. Therefore, you see copper moving lower as the dollar moves higher in opposite directions. We did have something of a waterfall last week. This was the most selling we've seen in some time. We'd really need to see this turn back in the opposite direction. Notice the volume by price bands here. This should be support. We've spent most of our time trading in this zone. And if you look at the monthly, you can see it more clearly. Doesn't look near as bad on the monthly time frame, but it's critical that we hold this level because back in 2009, this led the markets. We reversed 3 months before the March low and reversal. And again, during 2016, we started to rally after the presidential election and have since been moving sideways. For home builders, construction, and building products group stocks, we want to see this moving higher. So keep an eye on copper, very important for those industry groups. The other commodity, West Texas crude and Brent, we need to keep an eye on. Do remember that back in October through December, we had this cascade and waterfall event. While this is good for the consumer, it's positively correlated to the market. So if this accelerates to the downside, that would create something of a headwind for equity traders. We really want to see this bounce. You could argue that this is a channel or a sideways range, and we're at the lower part of that range now and could see a bounce in the opposite direction. If you're bullish equities, you want to see this bounce in the short term. With strength in the US dollar, you would think gold should be moving lower. However, we are managing to grind above the 9-period EMA and the 21-day moving averages. We're just below the highs. We felt last week that if we could test the highs and break out, that would signal a return to safety as traders look for safety in gold and US dollar assets and bonds. We're looking for this to either break out or break down. At the present time, this chart is more bullish, so looks like the safety trade is on with all of the concern with the coronavirus continuing to populate the media, scaring the general public. Do remember, however, that markets tend to right themselves shortly thereafter. These epidemics or concerns versus market performance tend to be rectified shortly thereafter. In each case, when we had a plague or a problem since the 1980s, the markets continue to rise shortly thereafter. So while the most recent move lower in 2014 with regard to Ebola did have the markets move lower by 5% or so, we did manage to move higher in the months that followed. So the takeaway is we're not doing anything major to our retirement account. Longer term, we should be fine the way things are positioned at present. And we look forward to a rising market going forward. Short term, another story. The sector heat map has turned more red and orange, so the changing colors suggest that the markets are cycling in a more bearish direction at present. Do note most of the reds and oranges are in the financials that are fading after a very nice run over the last couple of months. We did see a little weakness in healthcare, also in energy, metals, mining, and consumer discretionary, with strength in real estate, REITs, technology, internet, semiconductors, and utilities. International markets have faded as well and started to turn a little bit more oranges and reds, with strength in Turkey, weakness in China, Singapore, the Asia countries for obvious reasons, and Europe. So we'll enter the week a little bit more cautiously bullish going into Monday and Tuesday. Here is the IBD 50. First thing we notice is a lot of the stocks are mixed. Some are below, some are above the 20 period or 50 period moving averages, the blue and the red respectively. We're looking for stocks in the weekend video newsletter that are above and appear to be ready to bounce, like we see with ASML. At the 21-day moving average, there's a potential for this to bounce. RSI has turned back up. We did see buyers on Thursday, noted by the wicks in the bottom of these candles. We did see above average volume pointing in the opposite direction on Friday as well. Chegg also looks similar. It held the 9 EMA nicely on Thursday and Friday, giving us a reading of relative strength. RSI showing muscle. MACD above its signal line, starting to flatten out a little bit. This is borderline. There's always a possibility it pulls back to the 21-day, but keep in mind that if it bounces and follows through on Monday, this could signal potential break above 43.87. Chegg is a purveyor of ebooks and printed materials for students, textbooks, etc. In addition, REITs fared well last week. EPRT, Essential Properties REIT Trust, trending along the 9 and 21-day moving averages. The last test of the 21-day was back here at the beginning of the year. We pushed above and has since held above the 9 EMA with one test of the 9 EMA last week, followed through on a bounce on Tuesday. This high is most likely the next target to be tested if we do have a bullish follow-through day or two on Monday and Tuesday. FleetCor Technologies also showing relative strength, rising, breaking above this 315.75 zone last week. Nice little flag and continuation. 9 EMA is accelerating away from the 21-day, and we see standard deviation starting to approach this area back here in August, where we had this nice pop that led to a top and then a follow through. So there's a potential that this strength can continue. RSI is rising, just now getting above 70 on Friday. Franco-Nevada gold. We felt that this held the 21-day, and gold managed to trend and move higher as it is presently. That we would see potential breakout. We got that last week. Looks bullish. And in the past, when we've seen acceleration like this, price action tended to stay within the upper ATR 3 bands and just grind higher. We'll watch this time to see how this translates with RSI showing muscle now above 70, MACD above its signal line, and lots of volume indicating institutions were picking up shares over the last couple of weeks. Would love to see a little flag on Monday and Tuesday and then a follow through as an entry. Some of you traded in mode last week. This is continuing to trend after testing the 21-day and the 9 EMA. The 9 EMA is starting to move away from the 21-day. RSI is rising above 50. Above average volume on Thursday and Friday. A little bit of selling, most likely scared money. MACD is above its signal line. We're looking for follow through and continuation to the top of this trend. That's another 10 points from the close on Friday if we get back up to 58.76. RSI needs to turn back up as a function of price, which would suggest there is more upside if that happens. Leidos Holdings, we're looking for this 21-day to get tested. If that happens on Monday, Tuesday, look for a bullish follow-through day. For continuation, the trend is still bullish, just a little bit overheated. Pulling back, LULU looks like it could continue higher. RSI is above 50, price action pulling back to the 21-day. Most likely, volume tapering off, a good condition on the pullback. We'd like to see a bounce at the 21-day and MACD turn back up as a function of price for potential entry on Lululemon. Netflix back on the IBD 50 list. After a stellar earnings run there, we popped up. We did see a little selling up near ATR 3 bands. RSI suggests we could see more upside. We have this gap over here to deal with. A flag would be an interesting entry. If strength persists and there is no pullback, volume suggests that we could follow through and continue moving higher up to this 380, 385 zone that we saw back in July. So be aware of it. RSI, MACD both moving higher. Standard deviation showing that there still is some potential before getting to a peak like we saw here on this run to the upside, meaning we have this wave just now unfolding, and before this gets overbought, as it moves away from mean and then starts to revert, there's a potential that we have a bit more to go to reach that level. So watch that on Netflix. We could see a nice little follow through this week. Palomar Holdings, another stock that's above the 21-day and the 90 MA for 3 days last week. Volume increasing as the markets pull back, showing relative strength and potential for a follow through back up to the 57 level in the short term. RSI is above 50, rising. MACD crossed last week. We're looking at volume as suggesting institutions want higher prices in the short term. We've said many times that we like stocks that pull back. We want to buy the pullback, not the break to the upside. As an initial entry, if you didn't take Planet Fitness over the last couple of weeks, you're getting a potential great entry right near the 21-day. Bullish trend. We got wicks Thursday and Friday showing buyers had stepped up or shorts are covering, or both. Just below the 90 MA, just above the 21-day. If we see a bullish day or a test of the 21-day on Monday, I'd be very interested in this one. RSI is just below 70, and MACD is flat, just slightly below its signal line. Volume was somewhat muted compared to the breakout over here on last week's pullback. So this is a good indication Planet Fitness is headed higher in the short term. Safe, looking pretty interesting, breaking out above 42.84, relatively inexpensive name. Doji on Friday, bullish action all week, volume above average, MACD above its signal line and rising, most likely will continue higher. Toro, another stock that's pulled back to the 21-day, volume tapering off. The best of all situations on pullbacks. Very interested in buying this one, potentially. If RSI stays above 50, turns around as a function of price, of course. If we get a bullish day Monday or Tuesday, look for the 21-day to hold. MACD's crossed, but it is on lower volume. Winnebago's had a nice run out of this flat base at the 21-day, popped above, came back to the 21-day recently, moved higher. Remember, when stocks don't pull back to the 21-day, it's showing strength of trend. When it holds at a pullback to the 90 MA, just above the 90 MA on Thursday, Friday, look for a follow-through day and for this to continue trending as a potential entry on Winnebago, manufacturer of mobile homes. Also keep an eye on Boeing. As we mentioned on Friday, good news from the FAA. We've got also potential that Warren Buffett is interested in buying. Notice the volume here. Which indicates at the lows here, somebody was picking up shares. Maybe with the new CEO, there's a potential that Warren did, in fact, take a position in Boeing. So we'll have to wait and see what the 13F says. If he does file one, it'll come out shortly. And we'll get an idea if maybe we're headed back to the 370s. First targets would be the 21-day, then the 200 EMA, and then these levels if Boeing manages to turn itself around. We did see a rally in a lot of the airlines as well on Friday. So be aware of that. Some of these are reversing, like United Airlines, Southwestern, coming off the lows, following through. This looks better. LUV had a better reversal Thursday and Friday. It's going to do it for me for the week. I'm a bit under the weather, not feeling that well, so I'm going to get a little rest. I'm recording this on Saturday, January the 25th, 2020. This is your weekend video newsletter. We'll send out a watch list later tonight around 11:30 on the East Coast, 8:30 on the West Coast, so be sure to look for that. Bottom line, I'm market neutral. I do have a hedge on. If the markets do move lower first thing on Monday, Tuesday, I will look to take some profits off with those puts, utilizing those SPY puts as a hedge. As always, I hope this helps. Take care, and we'll talk to you soon.